On June 5th, the Bank of Canada reduced interest rates by 25 basis points or 0.25%, signaling the first of what will likely be multiple rate cuts in 2024 and 2025. This comes much to the relief of Canadians holding large amounts of debt and should hopefully redistribute some money currently being paid as interest back into our economy. To those tracking financial news, this was not a surprise cut by any means. It was widely expected that the first rate cut would occur either this June or in July, while in the US, it's now speculated that rate cuts won't start happening until after the US federal election in November, with their first rate cut potentially occurring in December or in early 2025. This will likely limit the number of rate cuts we'll see here in Canada this year to a total of 2 or 3 rate cuts, bringing our overnight rate to either 4.5% or 4.25%. In this video, I'm going to talk about what this first rate cut might do to the real estate market short term, and circle back as to why I suggest everyone that's looking to move exercise some caution. I'm also going to talk a bit about the condo market, which is performing pretty poorly, and the amount of supply that exists on the market today. For those of you that don't know me, I'm Jonathan Lee. I'm a Toronto area realtor based out of Etobicoke. I do monthly market update videos, property promos, and real estate educational videos on my channel. If you like Toronto area real estate content, hit subscribe. And while you're at it, click on that like button. Toronto 416 sales in May 2024 totaled just 2,700 properties sold between both condos and houses. This is based off 9,029 listings having come on the market. You do the math, and that's only a 30% sales to new listings ratio. Sales are down about 18% year over year from May 2023, where we saw 3,285 sales off 4,950 listings. Our spring market is looking rather flat for the year, especially when you compare it to the previous 5 years, save for 2020, the start of the pandemic. And nowhere is this experienced more than in the condo market. The condo market, which saw only about 1,300 sales this May in the 416, with about 5,800 active listings, has the lowest sell-through at 31% and the highest months of inventory at 4.3 months, going back almost 30 years to 1993. What is going on? Well, it should come as no surprise that the condo market has the highest ratio of investors and landlords, and when you couple low economic productivity and output with high interest rates, you run into scenarios where it's starting to cost landlords quite a bit to hold on to their condos and deal with tenants that, quite frankly, they hate renting. Some landlords are paying upwards of thousands of dollars to hold onto their properties while leasing to sometimes problematic tenants. And many of those condo owners are done being landlords. They're just done with it. And it's strange because we're still in this housing crisis. We still need housing to be built. But the longer we have high supply in the condo resale market, the more likely that condo prices will drop, and the larger the gap we'll be seeing between pre-construction prices and resale condo prices, meaning buyers will instead opt to buy in the resale market and new housing will not get built. So it's going to turn into this self-perpetuating cycle of prices dropping and then rising again in the future as housing needs grow even more. But as landlords are selling their investment property, there is this shift occurring, moving away from investing in real estate and instead investing predominantly into stocks. Stocks and options, if you're adventurous, are now the preferred form of investment for every age group outside of millennials and young Gen Xers. And it's not hard to see why. Firstly, real estate requires a huge upfront capital investment. If you're buying an investment property, you require a minimum of 20% down payment, which even for a $500,000 one-bedroom condo will cost you around $100,000 plus land transfer taxes to purchase. Most landlords also don't buy an investment property before they've bought their first home. So anyone under the age of 30 years can't easily get into the real estate market. As opposed to stocks, I mean, depending on what your choice is, you can buy a stock for as little as pennies or a few dollars. Investing through your TFSA or your first-time homebuyer's account or RRSP, saving money through just various tax shelters. Secondly, every past or present knows that being a landlord, at least a small-scale landlord with a heart, is not a passive investment, despite what some misinformed social media influencers say. Sure, there are many months where you're just cashing in checks, but from my experience, many tenants will wear out properties or will complain of issues, sometimes things that are completely out of control for the landlord, or will cause issues for neighboring tenants or properties which end up coming back to the landlord or will cause issues in the property that require the landlord's money or attention, like pests or property damage. All while in this day and age when most people are dealing with some form of financial challenges and hardships, the tenant is acting contentiously towards the landlord. So yeah, it's not passive at all and requires long-term optimism being a landlord. But here's the dirty secret. The Toronto housing market needs condo investors in order to build more housing. I know tenants and non-homeowners think real estate investment is a sin and that investors are restricting inventory that would otherwise have gone to an end user, creating a situation in which there is less supply, therefore jacking up home prices. This can and does happen to a degree, but new condos wouldn't get built if pre-con investors didn't buy them. Pre-construction is overwhelmingly purchased by investors. I've only met like 2 people who bought a home pre-construction with the intention of occupying it themselves. And if it takes years to sell out a building, all while building and labor costs remain variable, how likely do you think a building is going to get built? You guys should think about that a bit. So year to date, we're only at 11,033 sales through May in Toronto's 416. In my past videos, I explained that an ordinary or normal year, what is that anymore, we'll see between 32,000 and 35,000 sales transactions in Toronto through the year. So for the 3rd year in a row, we're trending below the normal. Jan to May 2023, we saw 11,385 sales, with the year finishing at 24,445 sales. And Jan to May 2022, we saw 15,143 sales, pretty decent for the spring, but with the year finishing at 27,864. Now the last 2 fall markets were just brutal. They were terrible, as you can see from this graph right here. Just dreadful sales, even with a high ratio of listings. But with this first rate cut happening this June, it will have an impact on the real estate market, even if it's small. Some buyers are going to regain confidence to head out to the market, and some realtors, they're going to persuade some buyers whose ears they have that now is the opportune time. This small rate cut will also increase buyers' budgets, not by much, only by about like 2.5%. So, if you're qualified for $1 million mortgage before, you can now qualify for about $1,025,000. And realistically, that's not going to change things by a whole lot. However, more drastically, this rate cut may also signal to some buyers who were holding back that it's okay to spend more money, because in a year's time, interest rates might be 1% lower, which is more significant. But this isn't likely to happen right away, like this month in June. Every June and July, many would-be buyers opt out of home shopping and into summer mode. You guys know the summer is only 3 months here in Southern Ontario, so you gotta savor it while it's around. But we'll know if it's gonna be an active fall if, come August, in advance of the fall market, buyers start quietly coming out to beat the fall rush, and we start to see properties that have been sitting for a while, little by little, getting picked up and inventory start coming down. We might end up returning to the most normal fall market that we've had in the last 2 years, but I would caution stating that we're heading back to normal, because I think that once we cycle through the buyers who were ready to go, who were sitting at the edge of their seats, deposit checks in hand, ready to buy, we're also facing some pretty serious stuff that our economy needs to cycle through. We've been decoupling away from the US economy for some years now in the form of per capita GDP growth. And anything short of home prices either staying flat or dropping as interest rates also drop will continue to restrict growth in our economy, especially as more Canadians are leaving the economic centers and are being replaced by temporary migrants. Those migrants who will eventually turn into PRs or new immigrants will use every penny to pay rent or service mortgages to own their homes, limiting money cycle through other avenues of our economy. We have every major Canadian bank writing off billions of dollars in loans, and even if we avoid an increase in these write-offs and Canadians manage to weather out the storm without defaulting on loans, we will still see a lot of capital trapped in servicing debt at higher rates than when interest rates were near 0%. And very significantly, we're only partly through year 1 of the 3-year timeline of $900 billion of Canadian mortgage renewals coming due, the majority of which will be in 2025 and 2026. So more than likely, both within the housing market and in our overall economy, we're still due a lot of pain. And lastly, if real estate history tells us anything, it's that most mortgage delinquencies don't happen until after rates start coming down, when property owners realize that they won't be able to hold out and rate cuts aren't happening fast enough. So, will this recent June rate cut have an impact on the real estate market in 2024? Yes, but is there more pain coming to the real estate market? Yes. In my mind, I'm thinking that we'll probably see a recalibration of the market occur in 2025, especially if we see multiple rate cuts happen this year. And if Canadian inflation starts to run away again and the US delays their rate cuts even further, I wouldn't doubt the possibility that rate cuts cease completely. So that's it for me. If you're moving this year, exercise caution and stay informed. Once again, I'm Jonathan Lee, a Toronto area realtor based out of Etobicoke. If you want to connect to chat real estate, you can click on the calendar link below. Cheers, friends.